Hello everybody. Today we are holding our webinar dedicated to creditworthiness, how we can check it and trust our clients. So how about sound? Wow, great. Thank you very much. So, okay, let's do it. Why we do have this webinar today? And why creditworthiness is actually of any importance to people who do business and who actually busy now in the office. And let me start from the very basic fact. Every transaction contains element of credit. It's very easy to prove because when we sell something or when we buy something, product, service, whatever it is, we cannot perfectly coincide two events, the payment and the event of transfer of goods or rendering the service. There would be always a time difference between the two. Credit exists in every transaction and it exists to facilitate trade. Use of credit is not free because whatever party uses credit, it receives two issues. Necessity to finance this credit. This would be the first one. And second one, credit risk. So if we simply generalize that, there would be credit in every transaction, and every transaction to a certain extent contains credit risk. Therefore, creditworthiness of a counterpart will always be of importance. We need to know creditworthiness each time we give credit to our clients. We need to know creditworthiness of our suppliers when we send them advance payments. There is also another situation, a little bit of exceptional from credit side, but when we place an order with a supplier, especially when these goods or when this service is critical to our business, we better know their creditworthiness, we better know their financial stance, because insolvent supplier would be unable to deliver goods we ordered. Therefore, we better know creditworthiness of our counterparts. The way we assess creditworthiness is also important. There are lots of literature which says that creditworthiness is actually probability of default, and then we need to find a way how to assess it and how to make sure we understand clearly what is our counterpart's creditworthiness. And this creates another problem, because since it is difficult, since it is not very clear to everybody, there are lots of ways to assess creditworthiness. Most strange thing I had in my life, I've seen a request for credit in a big corporation which says there is no credit risk because customer paid last 2 invoices on time. Very good, but even if we accept only 2 invoices as a risk assessment, it has to do with the past, not what will happen tomorrow. Past is a good prediction, but it is not for everything. There are lots of others. So today, mainly, I will be answering to the question what creditworthiness is not. Another problem, if we simply deal with the credit risk, this would be quite easy task. We can define if our customer is good or bad, and then we choose. But the problem is we live in competitive environment, we live in competitive world. Let me use as a proof a recent report of the Club of Rome, which is called Come On. Among other things, it says that we already live in the full world, where we cannot discover any new territory and then, get richer, exploiting resources of the world. We live in the world where we have to compete nearly for everything. For instance, if we ship goods, we take risk, but if we don't ship goods, we take another risk, because we may lose sale, we may lose market share, we may lose profit, because goods on our warehouse don't provide us with a profit, they simply an expense. So actually, modern methodologies about risk management say there is no risk management, there is risk-based decision-making. If we apply this analogy to credit management, we will say that there is no credit risk management, there is credit decision-making. And how we take these decisions? Let's try to have a look. In practice, when we work in credit department, or when we work in finance, or we simply do business. There is customer who wants to buy thousands items from us, and these thousands items cost, let's say, $100,000, and then we need to define whether or not we are ready to give such a credit to this client. We may check their creditworthiness somehow. We may look at their business report, whatever it is, and we got probability of default. But how can we take decision having specific amount and probability of default? It is very hard. Another problem. If we understand the probability of default and we find this combination, try to explain that to the salespeople. It is even harder. I had that nice discussion in the office of CFO with the sales director. The client come to us and said, okay, we would like to buy, we need, let's say, $100,000 credit line. Very good. I said, can we ship to them? No, because my answer was why? Because they got probability of default 10%. So it is too high. And the logic of sales director was quite clear. Why do you think it is high? So 90% probability that customer will pay is not enough for you. For me, is enough. I'm going to take it on my side. For majority of people who are non-specialists, probability of default and amount are actually, apples and pears. Even if we find a way to take decision, it would be very difficult to explain it to us. We are not dealing simply with the credit risk, as I said. We are dealing with the two risks at the same time. We got risk of the bad debts and we got risk of the loss of a sale. But even these two could be managed quite easily, but there is a cost. So we are like rope walker with the side wind of the cost, which is blowing constantly and don't give us a chance to relax. No, we can simply cover everything with the bank guarantees, but then it's a question of cost. These guarantees will cost us money. If not, it's okay. Ladies and gentlemen, if you can sell only on prepayment, do it. If you can cover your whole portfolio with the bank guarantees at no cost, do it. Do it any moment of time if it is possible. But there is also other side. And if one day we have to go above that and we don't know how to analyze creditworthiness of our client, we might be in problem. That's why we are analyzing creditworthiness. That's why we use it, and that's why we got all of these methodologies. Risk of bad debts or credit risk is actually coming through four main scenarios. It's scenario of fraud, it's scenario of country risk, it's a long-term fraud, and it is insolvency. A lot of people are actually scared, especially in sales, with the creditworthiness assessment, because they say if customer is not creditworthy, we won't be dealing with them. The key problem is that we should not mix credit analysis or analysis of creditworthiness and credit decision. These are two separate stages of credit process. We analyze creditworthiness, then we have a look what is the credit demand, and then we decide what to do with this. Yeah. Can we work with the customer? Should we work with a customer of low creditworthiness? Obviously. It's just a question of business reason. We just need to know what risk we take. The credit decision itself, it is solution. When we talk about credit decision, this would be credit term, this would be credit limit, and then there would be a collateral. And to find this optimal terms of credit, we need to compare two things, which you see on slide. We need to look at credit demand, and we need to look at credit worthiness, and then we need to compare them, and then to decide what we are supposed to do with the difference. For instance, in order to deal with the customer, we need to give them credit limit of 1 million, whatever currency is, and but their credit worthiness is 500,000, and then we got 500,000 credit risk. So we need to decide whether or not we accept it, or let's say we simply ship the million, or we reject it, like another way to deal with the risk. So we simply give them credit line of 500,000, or we cover it with a security, bank guarantee, insurance, something like that. If we know credit worthiness, which is reflected properly, and we and then we compare that with the credit demand. We perfectly know the difference when we understand what size of security do we need. So that's an argument why we need to reflect creditworthiness in money, in language, or let's say in the units of measure, which would be clear to everybody. Money is clear to marketing, to sales, to general management, to HR, to whoever else, especially for accounting. That's why when we define creditworthiness, we need to answer a simple, very simple question. How much money we can trust to this specific customer? With the probability of default, there is another issue, because, you know, two companies, big and small, may have the same probability of default. And if we can trust quite a big amount of money to a big company, I'm not very sure that, you know, the same amount to the smaller company with the same probability of default will be enough, and this will be safe. Several properties of creditworthiness is that it takes perfect sense only for a specific legal entity, and we can define it if we exclude other risks or risks with zero tolerance. The first step, we need to define the entity we are dealing with, not the owner, not the group, not somebody. We always deal, especially in B2B transaction, we deal with a specific entity. So we need to be absolutely sure that an entity or person we assess is actually the one we will be dealing with. The owner only responsible to the extent of money invested, which means the owner's money are already in this company. We cannot count unless it is legally linked on the money of the owner, on the money of the group. So if, for instance, somebody come to you and say, okay, we are dealing with, let's say, with this entity, but they got owner, and if they say, okay, this entity is quite weak, but the owner is actually of responsibility, they're supposed to be legally linked either with the parent guarantee letter or with a specific contract, and so on, because in the end of the day, legally, owner of the business is not responsible for that. It's the company who takes this responsibility. So we define entity, liability, then we need to make sure that the entity we deal with, actually exists. It doesn't. There are two special cases. First case is that we got documents which are fake, so it's like fake company. Fake company means that it is not registered or it is cancelled, and so on. All these scenarios. So with somebody is coming with a fake passport in the state register. This company don't exist. Another case, the company may be legally registered. It is not cancelled. It just exists only on paper. The data you got, there is somebody assigned as director. There are all zero enterprise. So it's quite useful for the fraudsters to use such an enterprise to come to you and pretend, okay, this is we've got a big business. The risk of fraud has zero tolerance. So each time you look at the company, you're supposed to have pretty clear answer whether or not this entity or this person is not fake, it is not fraudulent transaction. One of the best markers of fraud is actually time. So when fraudsters come, they always insist, this is the unique opportunity, quite big profit, so on. Each time you got doubt, take your time, take a pause. The same story with the compliance. Compliance is quite wide topic to discuss. Majority of companies already got compliance officers or compliance providers. So first of all, we need to make sure that our customer does exist. Second thing, if we put it in simple question, second step to make sure and to be on safe side is to make sure we are legally allowed or we simply allowed to deal with them. Compliance could take another day of the webinar to discuss all the regulations, all the sanctions, everything's supposed to be taken into account before you enter the contract. Good and simple example, licensing. For instance, if you are to ship goods to your client and this trade requires license, you need to double check whether or not this company or this person has a license, and you need to double check this license through the independent source. So fraud and compliance supposed to be checked through the independent sources of information. And we're moving further. Country risk is important when we deal with the customer cross-border. When you are with your client within the same country, it is not really necessary because you are in the same economic situation. But when you do an export transaction, when you either send advance payment across the border or you ship goods, you should include into your assessment country risk, because economical situation within the country will always be affecting the creditworthiness of your client. If we take Apple or let's say Google, quite big company, and they got different legal entities around the globe, but we can easily understand that Google United States and Google, I don't know, Bosnia and Herzegovina will be a different credit risk. And if we go to Bangladesh, it would be another different entity with another credit worthiness. Pretty simple rule is applied here. It is not very wise, but it's one of the simplest and easiest to use. It's like country selling. The rating of the counterpart could not be higher than the rating of the country. Big rating agency, big three, Standard & Poor's, Fitch, and Moody's, also DBRS, and some others do already good job assessing countries. You can always check and monitor, obviously, country risk on the internet. It's quite easy. And each time you deal with the cross-border operation, you're supposed to pay attention to country risk. Long-term fraud is actually look like insolvency. An entity you work with, everything goes okay, but one day owners or managers take assets out of company and leave creditors to arrange them on themselves. This happens, and this confirms, existence of cases like this, fake insolvency. Let's put it this way. Let us know that we are not managing our customers and suppliers. They got their own management, so we're simply dealing with them and we deal with the risk. When we excluded risks with zero tolerance and we paid attention to country risk, we may assess the creditworthiness. For that, we would need financial statements. These financial statements, this accounting exists for, being created by Italian monk, and it exists for last 500 years, and all these 500 years it is criticized. So people are criticizing it because it is outdated, because it is inaccurate, but there is nothing better. No one yet proposed something which would be as good as financial statements. So we have to look at them. We have to look at them, and then we need to understand the financial stance and creditworthiness of our counterpart. There is no lack of methodologies to say if it is good guy or bad guy. The real problem, as I said, is to retranslate this understanding into how much money we can trust. I will give you a couple of ideas how we can do that, but before we need to understand whether or not our customer is liquid, independent financially, and effective as a business. The better we understand our client, the better we take credit decisions and better results we receive in the end. Three main areas to check. First is liquidity. So current assets, current liabilities give us an idea. Do they have enough money to pay, enough free money to pay their obligations? There is quick liquidity, or there is general liquidity. I always suggest to everybody who analyzes creditworthiness to pay attention to other liabilities and the content of that. Simply pay attention, because other liabilities sometimes excluded and liquidity is getting too big. Just don't be misled. Equity and independence. First thing to do when you do credit assessment is to save your time. You look at customer balance, pay attention to the capital item. If the capital is negative, or if it is like in Germany and Switzerland, negative capital is shown in assets. So each time assets are lower than liabilities, this company is technical bankrupt. You may find a way to deal with them, but technical bankrupt supposed always to have zero creditworthiness. It is like this. Another good thing to remember is intangible assets. In vast majority of companies, intangible assets do not represent a big amount. There are brands which cost hundreds of billions of dollars, like brand Marlboro, like brand Coca-Cola, and so on and so on. But the problem is transferring it into cash takes a lot of time. And if obligation is due tomorrow, we cannot pay it with our brand. We might take loan for based on it, but I'm not sure. So if you see in the balance, big number in the line of intangibles, you better exclude them or ask for the explanation of your client. I got a case in my practice which was quite nice. So everybody knows the customer is actually zombie, but when we take their report, for the credit reference agency, their creditworthiness is 100 from 100, so it is the highest one. But if you look into the balance, you can see that intangible assets representing like 50% of total assets. That's quite big. So by excluding them, we understand that the customer is actually technical bankrupt. By the way, if you use international credit reports, some companies pay attention not to net worth, they pay attention to tangible net worth, which is much more precise. Or you can simply do like a red flag. If intangible assets represent, say, more than 3% or more than 5% of total assets, this is red flag. You can not simply define creditworthiness, you need to do deeper investigation. Capital or equity or net worth define as the financial strength of the company and actually how much money owners of the business put in it or keep in it. Good sign, by the way, if you see the profit for the previous period is not distributed and stays in the company's balance sheet. Profit itself is not the most, and I've heard many opinions like first of all we need to make sure that the customer is profitable. It is not necessary. Certain period of time, customer is supposed to live without profit if they got enough equity or they got for a side source of finance. But if we have high profit, we also need to pay attention to long-term liabilities. Very often, companies distribute profits among the owners, but at the same time they got long-term liabilities which stay unpaid. Sooner or later, these long-term liabilities, which under IFRS is payable more than a year from the date of report. One day the company will have to repay these long-term liabilities, whether or not they earn enough money now to repay these long-term liabilities. These are like simple tricks to pay attention when you analyze creditworthiness of client. What is also important is not to look at 1 year. If we come back to this slide, you see here normally we use 5 years, at least 3 years to see trends, because the trend is actually the main driver for the decision. For instance, company may be in difficult situation, but we see it is recovering. The same story for the profit, the same story for the equity, the same story for the liquidity. Like liquidity could be not so good, but the company is on recovery stage, and we may speak with customer, we may ask for additional information, and actually take decision based on the trend. By contrast, if the company is on decline, like liquidity is getting worse and worse and worse and worse every year. So we see that one day, even if they are credit worthy now, they might not be like this in several months or in couple of years. Three important things to know about credit analysis. Calculations is to be performed by computers. Credit analyst is not the one calculating. Credit analyst is the one writing, is the one who is explaining the numbers, why they are so. And then decisions are taken by those who authorize. Even a credit manager, I've been a credit manager, used to play two roles. First role is the role of the credit analyst, so I need to define the credit worthiness of the client, and then I need to find a way what to do with this client in such a financial stance, with such a credit worthiness. Either recommend this decision to my management or take decision myself. If we summarize this analysis of credit worthiness, there are 7 steps, and I will explain last 2 in more details here. So first of all, we need to define entity. Then we need to do check for the fraud. Then we do compliance check. Then we check country risk. And finally, we analyze customer credit worthiness. Then we find a way how we will be dealing. So based on the credit worthiness, we define the credit limit, we define the credit term, and we define whether or not we need a collateral. After this, we do 2 important steps. Every financial knows that credit worthiness is changing. It is actually changing with the financial stance of the company every day, if not every hour. The same story with the legislation, with the regulation, with the changes in the world, with the politics, everything. So we need to do 2 more monitorings. It's point number 6. We need to do monitoring for compliance. We need to be sure that we are compliant dealing with the customer at every single point of time. And then regularly we need to do a monitoring of client credit worthiness. Let's call it credit monitoring. We can do it, at least once a year when they publish their annual statements would be enough. So we do it, we check against existing outstanding of our client, and then we decide what to do. Where to get information about clients, and this is something about what we do in credit engineering. Best source of information is customer themselves. You check customer through the state registers and other resources like this, but when we take about financial statements, it's an act of giving a trust. Customer comes with their financial statements, and then you define. Very good if these statements are undersigned by independent auditors, quite important thing, but if not, for instance, they are not hiring auditors, it is not required by the legislation, you better take financial statements you've got instead of simply, taking blind decisions. Without financial statements, we cannot judge on financial strength of the company. Simply say they got billions of turnovers, so what? We don't know even profit. Simply say they got big property, again, they could be technical bankrupt, and we wouldn't know that until we see the financial statements. If you cannot get it from the free sources, like from state register or from customer directly, you can use international credit report. Credit engineering is one of such an agencies, and we do that. But you can use credit scoring or you can use credit analysis. You can automate that, but in some situations, scoring is a good thing. For instance, in telecom business or in any business where you've got big number of customers and you give them very small amount of credit. So if you let's use example of a company called SGS. They got 500,000 customers around the globe. I don't know, they need an army of credit analysts to analyze all of their customers, but again, this is not necessary. For some of them, it is quite enough to simply use scoring model. The amount of credit they trust to their client is very small, is actually tiny in comparison with the business of their clients. More or less the same situation, for instance, with the telecom providers. Mobile telephony could cost certain amount of money, but if you compare that with with the whole company business, it would be quite tiny. So in that case, it might not be necessary to actually spend a lot of time to analyze their creditworthiness. But when the customer is big and it represents a single percent of company's business, you better analyze it, and you better analyze it. And again, remember, when we reject client, there are our competitors who ship goods or render service to this client and make profit, and we will be sitting with our product on warehouse. So we always deal with the two risks at the same time: bad debts loss or financial loss, and loss of profitable sale. This is where we take decision. This does not mean that we need to adjust the methodology of credit risk assessment. The idea is pretty simple. We analyze creditworthiness as precise as possible, and if it is zero, we call it zero. There's a question like what to do if we don't have financial statements. If we don't have financial statements, we simply say creditworthiness is zero. We take it as it is, and then we take decision based on zero creditworthiness. Try not to be, or do your best not to be misled with unclear things, like as I already said. Payment discipline is an important thing, but it is not creditworthiness. Belonging to the big group of companies, or VIP owner, or whatever it is, it says nothing about their creditworthiness. To be on a safe side, and then we take decision based on creditworthiness. There are other ways to do when we structure credit transactions. I promised gifts to everyone, and thanks to everyone who demonstrated so much patience to what I'm saying. So what are the gifts for today? You can choose one of them. I actually got that if you wish. So first one, we provide business reports, and we do outsourcing of creditworthiness analysis. The price for the business report is about $100. And we got creditworthiness analysis about $200 to every participant of this webinar and everyone who registered credit analysis on any entity in the globe for $100. Another gift to you: in Prague on 5 and 6 December, we will be doing a training, trade credit decision making. So every participant on our webinars will have 20% discount. Please register, please come, please contact me if you are interested. Let me quickly answer questions. Which color? Well, I don't know. Green? A date of birth every year, July 18th. How to scrutinize the company before credit approval? I think I already answered this question with the webinar. How to monetization of long-term contract payments? I'm not sure I understood this question correctly. You can simply discount long-term an obligation of client with the bank or with the factoring company. If I misunderstood the question, please clarify it or rephrase, and I will be happy to answer. Since we don't have further questions, I am at your service to answer them later. Please contact me directly to see news and to see our upcoming events, not to miss them. Please follow us on Facebook, on LinkedIn, and on the YouTube as well. Have a nice day to everyone, and we'll stay in touch. Thank you very much for participating in this webinar. Good luck. Bye-bye.